Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, June the 14th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Some economic data across the pond is in the form of CPI, which was in Great Britain, came in slightly lower than expected at 0.3%, expected 0.4%. But the core CPI also came in a little bit lower than expected at 1.2% versus 1.4%. Here in the United States, we got NFIB, which is the National Federation of Independent Businesses. It's just an index on their feeling of the overall economy. It came in line with expectation at 93.8. And then we had core retail sales here in the United States, which was core retail sales is ex-autos. So since autos are very volatile in nature on their sales cycles, it is pulled out of this number and is considered to be the more substantial number, the one to really look at. And it came in line with expectations at 0.4%. But with the autos added into that retail sales number, it came in at 0.5% higher than expected, the 0.4%. We also got business inventories, which was a little bit of a drawdown at 0.1%. That one, is a little wanky just because we don't know if they're producing more or producing more and selling more, or if they're producing less and getting rid of inventory. So that number is a little bit funky. We also had import prices came in at 1.4%, a little bit higher than expected, of 0.8%. So that could have been due to the weakness in the dollar that we've seen. But anyway, on to the overall markets. As you can see here, crude oil down about 56 cents. Been talking about this after it broke back below $50 a barrel. It's going to look to test this point of control. That's where the most time and volume has been spent, and that is where the market has accepted value. So when it gets a little bit further away, the bears start pushing down on it, and when it gets a little bit below that, the bulls start pushing up on it. As you can see here, NASDAQ down 11 points /NQ. Been talking about this since we came back below this volume node here, that it was going to probably want to come down and test this point of control, which is where the most time and volume has been spent. The price has been accepted. We came down and really rebounded off of that. As you can see on the E-mini S&Ps, that's a key Fibonacci level, as they do tend to line up a lot of times. The volume's been spent down here. The volume's been spent on this red line. The time has been spent on this yellow line. So we came down, tested that, and have rebounded back above this Fibonacci level. As you can see, E-mini S&Ps only down about 5.5 points right now. 5.5 points. On to the E-mini S&P on the daily chart breakdown of 15 minutes. This is the market profile on a daily chart, so you get a better idea as where the time and volume has been spent intraday, and it is right here where we are right now. The market came down, got a little overextended to the downside, and we've given back about half of those, or taken back half of those losses seen earlier today. Onto a couple of trades that I've done. This is SPY, ticker symbol for the Spider S&P 500 ETF, if you will. Now, I've been short these calls forever and just continue to roll them out, collecting more credit, trying to lower my overall basis on this. If the market wants to come back, then I decided to roll these out in time. And I had on the June 197 calls. Yes, they're deep in the money, but then I rolled that out to the July 197 calls, collected another 83 cents for that. So just trying to lower that overall cost basis increase my break even so that I don't have to get all the way down there to the 197s. I can basically, if it comes down to the 202 area or this line right here, I'm going to be probably looking to get out of that just because that'll be a good scratch. On to GoPro again, short these also, these 15 puts that are in the money as well, but just looking to keep that dream alive, see if we get a little bit of pop in GoPro now that they have on the Apple designer. Maybe they can come up with a sexier GoPro. Anyway, so in GoPro, I rolled my June to the July, but the Julys are the weeklies that expire on the 29th. And I rolled the 15 puts out for 30 cents. So I collected another 30 cents, lowering that overall cost basis on those 15 puts. My break even on that is in the 13s basically. And then Twitter, the same idea here. I've been short the Twitter 21 puts, which are in the money as well, and decided to roll those out. I couldn't get anything other than rolling them all the way out to September, so I rolled the June to the SEP 21 puts for an extra 20 cents. Again, just trying to lower that overall cost basis and lower my break even area. And then this one I just put on ComAmerica. Basically a participant in some of the videos that we've been doing, the webinars, reached out to me and said, hey, this is a great scan that you can do on TOS. And so I just kind of went through that scan today and found this CMA, which I've never traded before, so I decided to go in there. It's got really high implied volatility, as you can see down here at the bottom, pretty high implied volatility. So I decided to go into that with the basic strangle. So I did the July 39.48 strangle. So it's a little bit of a oddball. It's not even on both ends, and collected 95 cents for that. So the reason why I did that, I never traded it, but at the end of the day, there was a support and the resistance basically, the support would be down here on a, see if I can just pull up a quick chart on that, but basically it is outside of a couple Fibonacci levels on that. So that's why I decided to pick those strikes. And with the break even, it puts me well outside of those. So that was a nice little trade. It's a little bit wider markets than what I usually do, but I'm trying to find some opportunities to sell some premium in these markets. And then with Kellogg, I put on this strangle not too long ago. I did the July 72.5, 80 strangle, and everything's worked out real nice for me. Implied volatility's really kind of exploded on this market, so it hasn't really moved a whole lot. It's actually probably a better location to put this strangle on, and since volatility's expanded so much, I'm able to get more credit for it. So it's a losing position right now. The market hasn't really gone against me or tested any of my levels, so I decided to add a little bit more to this to capture some of that volatility expansion and increase my break evens a little bit. So just added a little bit more to that in Kellogg with the July 72.5, 80 strangle, and I collected another $1.90 for that. I think it was about $1.30 when I originally sold it, so got a lot better pricing for that. Then on to Capital One Financial. Now this was a huge winning trade. I talked about it. If the Fed doesn't go, the banks are going to get hurt. So I decided to go into this market when volatility was really low. It's the only time I really go in and buy options. And I have on the July 67.5 puts. And I originally paid 70 cents for these puts. Now they're at $3.45. So I take off about half of those. So half of my tranche to basically have on these puts for free. If the Fed doesn't go, I could see Capital One go quite a bit lower. So I wanted to keep on some of that, but if they have some kind of announcement that is a little bit weird, then I didn't want to be caught with that. Also with the volatility expansion after the FOMC tomorrow, that volatility could come out of those premiums. So I could even continue to be directionally right, but lose a little bit of money on that premium Friday, we're going to be doing a webinar on put calendars. So there's still quite a few stocks out there that have low implied volatility, and if we start seeing expansion or more of a correction in this market, we're going to see more volatility expansion. So that will help out that strategy quite a bit. So go to protraderstrategies.com, sign up for that. That's about all I got for you guys today. If you can't take that, take it easy.